it. Let's talk a little bit more about what the economic numbers are telling us and get some outlook perspective for the currency. Carlos Capistran is a LATAM and Canada economist with Bank of America Securities. Hey, thanks very much for joining us, Carlos. Appreciate the time.
Hey, thank you very much. Happy to be here.
We've been talking a little bit about this latest inflation reading in Canada, and it is interesting because on the one hand, you did see easing in inflation, which might argue towards a weaker Canadian dollar versus the U.S. currency. But I think people still see some signs of inflation under the hood, like what they're paying at the grocery store, and the market seems to be anticipating that maybe the Bank of Canada is going to be a bit cautious in the short term with, for example, cutting interest rates even further. Well, what's your take?
Yeah, correct. So the good news on inflation were mostly based on gasoline prices that are so low now, for different reasons. And that's why headline inflation printed below 3% and even below 2%. So it was a very good print on the headline front. The problem is when you look, as you said, under the hood, when you look at core measures of inflation, it was a bad surprise. I mean, core inflation is now clearly above 3%, and it's also clearly trending up. So the Bank of Canada is just not going to like both things, that is now above 3% and that it's trending up. Why? It's unclear, right? I mean, the economy is weak, you have lower gasoline prices, but the truth is it was across services and across goods, a little bit more services than goods, but it was across the board. So now we have this core inflation trending up. So I don't think the Bank of Canada is nowhere near cutting rates. For sure, in the meeting in 2 weeks, I think it's going to be very difficult for them to overlook this. And in that sense, we believe that the market needs to price out Bank of Canada rate cuts, again, at least for the upcoming meeting, but maybe even a little bit further in the year.
Well, we did see some of that among some of the traders in reaction to that data this morning. But I guess the other side of this, Carlos, as you well know, we're coming off a Canadian jobs report, which wasn't really something to smile about. And we even spoke with a guest earlier who talked about how dependent our housing market is on a robust labor market. So what's the Bank of Canada to do if the inflation story isn't exactly what it would like it to be at a time when you're seeing some deterioration in the jobs market?
Well, the Bank of Canada needs to wait a little bit more. You're right. I mean, the economy is weak. We are expecting a contraction in the second quarter. You saw a GDP contraction in the second quarter. We are expecting GDP for the year to be 1% with downside risks. So for sure, if you just look at the economy, you look at the labor market, the Bank of Canada has room to cut. And indeed, we do have the Bank of Canada cutting all the way to 2% at the end of this year. So we do have that. But the problem is core inflation is going the other direction. So most likely what is going to happen is the weak economy is going to get the upper hand on core inflation. And soon enough, maybe in a couple of months, we're going to see core inflation going down again. But I think at this point, a necessary condition for the Bank of Canada is to see core inflation below 3%. And hopefully with that, a couple of prints that shows that core inflation is at least not trending up anymore. And that would open the door for the Bank of Canada to be able to cut rates. And again, we do see room for them to cut below neutral and probably all the way to 2% to help the economy. Of course, this is only going to help the economy for next year or for the end of this year, not now. But the only mandate for the Bank of Canada is to look at inflation, and they really look at core inflation, and that is not looking good at the moment.
Now, the Bank of Canada also fields questions during their media availability about what's happening with the Canadian dollar, whether they want to answer those questions directly or not. For those who are curious, based on everything you're saying, how you think about the currency, which at our lows of the year got briefly below 69 cents. So the fact that we're closer to 72 cents highlights that we have seen some strengthening against the greenback off the lows. But you go back to the last fall, we were talking about a currency that was a lot closer to 75 cents. What's your outlook for the Canadian dollar from here?
So first of all, we have a weak U.S. dollar, and that dominates our outlook, right? I mean, there are many reasons for that, but we have overall and for the rest of the year a weak U.S. dollar. Now, in this context, we do see some specifics of the Canadian economy that should help the Canadian dollar, especially against the U.S. dollar. So when we look at that, for instance, our Canadian strategists are looking at 138 for the end of the year and then 135 for next year. So we are certainly looking at a stronger Canadian dollar here. Part of the reasons in the very short term, as I mentioned, we believe that the market needs to price out Bank of Canada rate cuts. Later on, we believe that growth is going to help the economy. A little bit of that is going to be the big fiscal package that we're going to see in Canada, and also the eventual cuts by the Bank of Canada. And finally, the other thing that may help is, in the tariffs game, in the trade wars, when you look at it in a relative perspective, both Canada and Mexico through USMCA, through the trade agreement, are relative winners. In absolute terms, they are losers, of course, because they are so exposed to trade with the US. But in relative terms, if you look at the effective tariff that Canada is facing versus the US, it's still the lowest tariff out there, and that should also help the Canadian dollar.
Carlos, unfortunately, we only have about a minute left, but we haven't really had a chance with the inflation numbers in Canada today to highlight that the idea of a, quote, staycation, because of the tariff worries and people saying, okay, I'm not going to go to the U.S. or what have you, it's actually created a heck of a lot of pricing power for travel operators in Canada. So is that something you have to consider? If the tariff war continues and people stay at home, does that inflation factor in travel in Canada stay sort of complicated in the math behind inflation?
Well, I think that you're completely right. And I think that one of the big items that brought inflation up this morning is precisely this effect that we are seeing, like Canadians consuming more local goods and services, and that's dominating in the short term. I think that, as I mentioned, I think that over time, the weakness in the labor market, the weakness in the Canadian economy is going to be first order, and that is going to win the day. But for now, this extra pricing power that staying in Canada and buying Canada is creating, it's something that it's putting pressure on inflation, and that at the same time is preventing the Bank of Canada from acting now.
Right. Carlos, thanks very much. Appreciate the insight. Carlos Capistran of Bank of America Securities. Come back with your latest headlines, and in the